Hi everybody, this is a short video that I promised you last class just to go over the mechanics of the cash flow statement. So a few of you expressed an interest like how does this cash flow statement come together? What does this mean, increase, decrease? And just wanted a little bit more familiarity with how this statement comes together. So this isn't a required video, but for those of you who are feeling ambitious, I have a couple of worksheets that I use in my advanced accounting undergraduate classes that might be helpful. And we'll just walk through them together and we'll see if we can connect all the dots. But our goal of this exercise is to just look at a statement of cash flows and then understand how it fits into the income statement, the balance sheet, and basically that general accounting equation you hear me harp on every single class. All right, so before us is a very simple cash flow statement. So statement of cash flows for fiscal year 2013. And you'll notice that the net cash flow was an outflow of $231,000. The beginning balance of cash was $50,000. So the end of year cash balance was $269,000. So the immediate question I'm thinking to myself is, what's going on at this company that they have $231,000 of cash outflow? So that's kind of what my primary curiosity. So looking from financing activities, there's no financing activities of note. They didn't take out any loan proceeds. They didn't make any loan payments. They didn't do any stock issuance proceeds, or they didn't get any cash from issuing stock, or they didn't pay any dividends. So this is a non-factor in arriving at our cash outflow. In cash flows from investing activities, they made a pretty significant purchase of a building. So that's a big piece of it. So that is something we'll keep on the radar screen. We'll be curious about that. And then operating activities is kind of a grab bag. They only had $14,000 in net income. They had a hefty amount of depreciation expense being added back to net income as a non-cash item. And then a handful of increases and decreases back and forth. So this is the area of the cash flow statement, the cash flows from operating activities, that tends to provide the most confusion with students. So let's hone in on it and see what we can find out. So right now I'm going to expand this schedule and we're going to show you where each of these line items comes from. So bear with me, this is a big schedule. But that net income that we just saw of 14,000, it comes on this line. And basically what that line is if you take this worksheet, should be familiar to you. This is the template that we use for our homework from chapter 4, but it's basically the transaction analysis template. But basically your starting point as doing the cash flow statement is you take your balance sheet and you basically compare one period versus the next. So I have beginning balance and I have an ending balance. And then I'm going to do an increase and decrease in those balances. So that 231,000 that I mentioned earlier, that's the change in cash. I'm going to drop that to the line net cash flow. All right? So that's net income line that you saw in the statement of cash flows. I'm going to drop my revenues minus my expenses, and that nets in the net cash flow. So let's just regroup before we get too overwhelmed with all that stuff. Let's just revisit. Net income was 14,000. Net cash flow was 231,000. That 14,000 consists of a revenue and expense piece. And that 231,000 is equal to your change in cash. All right? So what about all these other items? So let's look at the change in accounts receivable, for example. So they started out the year with 500,000 in accounts receivable. They ended the year with 476,000. So they had a decrease in the balance If your accounts receivable goes down, that means you're collecting more cash. That's actually a cash inflow. So that's a positive number. So when you look at your financial statements for Starbucks, for Harley, for Kohl's, you should be able to see a pretty close relationship between the accounts receivable on the balance sheet and the increase and decrease in the operating activities of your cash flow statement. So anyway, we're going to take this inflow, we're going to drop it on this line, and we're going to carry it all the way across to our statement of cash flows. So when you look at the statement of cash flows, that 24,000, it comes strictly from a balance sheet push. So let's look at decrease in inventory next. It's done the same way. We're going to come over here. Inventory increased from one period to the next by 14,000. So if you're paying for inventory, that's cash out the door. So that's a cash outflow. We drop that cash outflow, which is a negative number on the statement of cash flow statements. We drop it down into our little table and we carry it across to our cash flow statement, and that's how we get that. Similar scenario for accounts payable. So accounts payable is a little bit tricky, but bear with me. Accounts payable went up from 500,000 to 519,000. So it increased by 19,000. And I call that a cash inflow. Because if you think about it, these are expenses that are factored into net income, and the cash flow statement is basically a reconciliation of the accrual basis net income to cash basis. So if you have expenses that relate to these accounts payable that were not paid in cash, and you know that because accounts payable went up, that actually has a inflow effect on your cash flow statement. So we dropped a positive number on this line. The opposite was true of our income tax payable. We started out with a year with $500,000 balance. We had a decline in that balance, so that was a cash outflow. If it declined, that's because we paid it in cash. And basically we carry those numbers over, and as a result, we've got all of our operating activities. So this is a really crude and simple example, but each of your cash flow statements for each of your respective companies follows the same model. So let's look at something that has a little bit more complexity to it, and let's go to the building purchases. So again, this is the big driver of our negative cash flow for the year. So let's analyze this a little bit. Your buildings increased from 8 to 1.23 million. So if it increased, we're going to put that on our building purchases. This is also called capital expenditures in your income or on your cash flow statements. This is a very key number. The other movement related to property is depreciation. So depreciation increased from 300 to 400, accumulated depreciation increased from 300,000 to 490,000, and that we are calling an inflow. Now why is that? And we're dropping that down onto this depreciation expense line, which falls into operating activities. So let's think about why that is, because you will see this in each of your cash flow statements, and it's been coming up in analyses as far as I could tell. But this is a really routine part of the cash flow statement. Your net income, this first line, includes depreciation expense, but you don't pay depreciation expense in cash. When you pay for an asset, you just pay for the entire asset. And then you bleed off that asset over the course of its use. So if you think about Starbucks, when they buy an espresso machine, that might have a useful life of 10 years, probably less than that. But for each espresso they make, that equipment depreciates. So let's go back up, and that depreciation is not paid in cash. It's just a gradual bleeding out of the cash, of the asset value. So we're going to expand this model one more layer, and we're going to look at some of the transaction analysis to see how it fits in. So let's look at what you record when you buy a building We purchased it in cash. So buildings went up, cash went down, so our accounting equation remains in balance. Now let's look at what we did for depreciation. Depreciation has a negative 190, because this is a contra asset account, so it's kind of counting against the value of the buildings. And then we have net income, or we have expenses, which is the depreciation expense. So again, we have negative 190, we have negative 190, our accounting equation is in balance. This 190 falls into our net income number. And because this net income number includes a non-cash expense of $190,000, we have to take that $190,000 out in our operating activities. So that's a little twist that everyone is going to see in their cash flow statements, regardless of what companies you're working on. So there we have it. This little tool, as complicated as it might be in a webcast, this tool will help you, if you play with it a little bit, it'll help you connect the dots between the cash flow statement that you see and the accounting equation, the basic accounting equation that underlies all of the analysis that we've done so far this semester. So hopefully this example helps. I'll make this workbook available to you. I don't want anyone to think they have to know it. Don't get overwhelmed by it. This is a for your information piece to those people who are interested. Thanks.